want to talk today about capital because, that's my thing and that's what everybody keeps talking about. You know, um, when I say that you're part of a unique group of leaders, you can be sure that I am not overusing that overused word. No other group of startup leaders has faced the kinds of issues that you face in building your company under the global economic and social lockdowns that we've had in the past and that we are emerging from today. So, no other leaders from those glory days of fast VC money, large expense accounts, private jets, and obnoxious waste, let's be frank, can tell you that they had it harder. And they can't tell you they know it better because as of March of 2020, they knew and they know nothing. So, as we look at what is going on, since 1995, the growth of the digital economy has outpaced the US economy by 2.4x. Everybody's playing the game that we're in. COVID-19 pandemic, of course, accelerated that tech adoption and investors doubled down. So they increased annual investments for 2021 to $347 billion in the United States alone. Now, while investments slowed down a bit in 2022, you can see the charts. Just do a simple Google search, you'll find them, right? In 2022, from 2019, it's still a massive increase. So put things in perspective. The real question today is, why are women still fording headwinds and upstream rapids to get to such tiny pieces of capital to build their companies, right? It's still so difficult. In truth, pattern matching has a good deal to do with it. Right? At the Series A investment stage, a venture capitalist is betting on the team. They're not betting on the numbers yet. That doesn't come into the Series B when the production of capital is evident. At this point, it's all about the team, and you will hear that again and again. Companies that are relatively pre-revenue or early in revenue, the bets, the whole thing, can this team take us to the finish line, or at the least, is this the team that we want to back in this sector? And when the leader or the team looks like this audience, 90% or more female, there is a lack of pattern matching. The teams that came before do not look like you or me. About 2/3 of all venture capital is awarded to tall, white, American-spoken, youthful, slender, able-bodied males from Harvard or Stanford, just two universities in the entire planet, with a baritone voice. The raw truth is that this is because humans are comfortable with humans like themselves. It's ancient and subconscious behavior. If a humanoid infant cozied up to a saber-toothed tiger some 30,000 years ago, it didn't last long. It had to instinctively cozy up to its own kind, and it isn't only humans. It's all mammals and all the birds that fly in flocks and the fish that swim in schools in the sea, and even the plants on our planet grow in clusters. This is a survival mechanism of a carbon-based life form. We are not going to change it. So what are you going to do about it? The first thing, you're not imagining the problem. It's real. Now, let's look at some solutions. The first thing is to acknowledge it. In 2023, it no longer serves the planet to do those instinctive things, and people in my position are working to make connections to our colleagues to allocate capital at the highest levels, from funds of funds to others, so that those people who can make the investments into diverse founding teams are getting the capital to do so. Okay. I just come back from Davos, by the way, from the World Economic Forum, where many people are working on those kinds of issues across the board, both sectors, investment, and even in philanthropic efforts. It's the same numbers worldwide. So that's another conversation. Feel free to ping me on it. The second thing to look for is the lowest barrier to entrance, right? It's going to be tough to raise capital, get on with it, right? So this would include seeking out women in the investment decision-making roles. We just talked about being comfortable with humans like ourselves, right? Women are 3 times, not 30%, 3 times more likely to invest in diverse teams of any kind gender, ethnicity, racial, age, geographic, any other kind of diversity at the leadership team. We don't know why exactly, but it may be something about tending the children and the diversities of those children. Nevertheless, know the numbers. Women are 3 times more likely to say yes. The second thing is, I would say, look for capital from different places. Look for corporate funds, for example. Corporate funds tend to move more quickly. That's a good thing. They invest in companies with which they want to do business or with which they are already doing business. If you can do business with a company, it is far more likely to invest in you. There's a good path we're in. Corporate funds invest in companies they want to acquire. So this puts you on an acquisition track if that's what you want. Know what kind of a company you want to create. Many people are thinking, and particularly women now, are thinking about their life's work and capital wealth in different terms than their male colleagues. This has emerged over the last 2 to 3 years for us over at Mastersfund, and we are hearing it from our colleagues worldwide as well. So here's what I'm listening to. Women are telling me, I'm not building a unicorn company, but if I don't say so, I'm not going to get the capital. That's what I'm being trained to do. Now, there are 2 things to unpack here. First is that conventional venture capital is very specific and actually a rather small part of the segment of the capital markets. It's designed to capitalize companies that are building the technologies that will power the human existence on planet Earth for all those coming years. Well, you might loosely define that today as the software that powers the next big thing. And that's why you hear the words AI and IoT and blockchain and AR, VR and so on again and again and again. And you should. That's what it's designed for. But conventional venture capital is not designed to capitalize the companies that leverage those world-changing softwares to build the next decent thing. And many of us are building that. In short, if you're building a company that you'd like to operate and perhaps not sell or take public in a very short period of time, then conventional venture capital isn't a good bet for you. You're going to need to look elsewhere. The second thing is to look at how women are looking at their work and their wealth. So these women are telling me they're not building the unicorn company. They tell me what they want to do is to build a company. They don't have to run it forever. They put a leadership team in that position, and then they take the capital that is being thrown off by this cash cow. Why would they want to sell it? It's throwing off money to them, right? And they can use that to build their second company and then do it again and again, and perhaps even one more time. And then they can sit on the boards of directors of all those companies from anywhere in the world. And they can enjoy the financial rewards and the amplification benefits of these companies, which are often related, that they have built. It's just a different way to look at one's life work and one's capital wealth. So where do you find capital if you're not building a unicorn company? You could start with venture debt. All right, venture debt companies will generally take the bet, if you will, a little bit later in the game. Once you have revenue and you have sufficient revenue that there's about a year's worth, they can give you a piece of that revenue so that you can continue to grow and amplify. If you have product that you need to pull on board before you get paid by a customer, so on, there are loans out there specifically designed for product stocking. Right? If you have items you can leverage, for example, you have perhaps a building or other major asset, you can do mortgages even on the secondary market, not even on primary markets, which would be banks. It's still pretty low. It's not quite as low as it was if I were talking to you last year, but it's a way to go. So there are many ways to do it. In addition, there are ways to develop investment documents which you can use with angels by proffering it to them and explaining how they're going to get their money a whole lot sooner. So, for example, at Mastersfund, we offer kind of a venture debt, venture equity mixture, if you will. We come on the cap table as equity, and we use something called a redeemable preferred warrant. So we take pretty early risk. We're earlier than the venture debt folks. Just as a product is hitting the market, we begin to work with the company leaders to achieve, if you will, preset goal monthly revenues. They might have a few bucks, but we're going to set that goal revenue at a much higher rate. And when they achieve that, we know they can take a small percentage of that revenue each month and use it to redeem, which means buy back that warrant. Essentially, they're buying back their stock. Right? And when they do so, they've got choices. They can use that stock and recapitalize it by selling it to another investor at a higher rate. Thereby, they've paid back us and they're going to sell it for more, right? They can leverage that hedge in the middle, or they can put it back in their pockets and go on with their company, assuming that they now have achieved that stability in the marketplace. Choices. You can look at options in which you can have investors, usually at the angel stage, the same folks who are looking at conventional VC and thinking, oh my gosh, I got to wait 15 years before these guys, get the money back out. You can make revenue share agreements, very similar to what we're doing. Essentially, you can go to an investor and say, I will take the capital, grow my company, and return the capital on a revenue share basis over time. Okay. Or you can do dividend models. You can take in the capital, set up and grow the company, and when the company reaches certain goal target revenues per annum, not even per month, then you declare a dividend. Now, on that one, that's pretty good too. As the largest stockholder of your own company, in most cases, you participate in that dividend. And when you do, it's a more tax-advantaged way for you to take capital out of your own company. There are many other ways to look at how to structure these investment documents. They are good for certain types of investors over time. But the bottom line is, if you're looking for conventional venture capital at the Series A, right, know the numbers. They're not in your favor. Look for the VCs who would be more in your favor, right? And look for those corporate funds where they're making decisions a little less on the team and more on whether they want to buy that technology.